Welcome back to the Stock Market Options Trading Podcast. This is episode 13. My name is Eric, and today we're going to talk about index options and how they differ just a little bit from stock options or even ETF options, and basically why I trade them so much. You guys know I talk about SPX a lot, right? But before we get started, you should know that everything in this episode and on this podcast is for informational purposes only and should not be considered financial advice. And real quick, if you're already on my email list, you probably already know this. I've been sending you the emails, but I put together a 7-part video series for trading index options that I'm loosely calling an index options mini course. But I did something a little bit different with this course, if you want to call it that. Instead of making everything from scratch, I mean, there's already a lot of great educational content out there. So instead of me sort of redoing it all myself, what I did was I looked on YouTube and I found what I think are some of the best educational videos, and I put them together in a way that will kind of start you from zero and get you up to speed on trading index options with a real full strategy in 1 week. I know it sounds crazy, right? And if you would like the index options mini course, here's how it's going to work. After listening to this show, head on over to optionstrading.help/index options, all one word, optionstrading.help/index options. That's optionstrading.help/index options. So when you go there, there's going to be a form and you're going to put in your name and email, and I'm going to send you the index options mini course, and it's totally free. And then I'm going to send you 1 email per day for about a week. I got 7 right now. I'm actually going to I might add another email or 2 with a couple other things, but right now it's 7 parts. I'm going to send you 1 email a day for about a week, and each email contains what I think is some of the best videos explaining various option concepts geared towards making consistent money trading index options. And again, most of these videos aren't even the ones that I made. They're just various various other YouTube channels. You're going to recognize some of them, right? But they really are some of the best videos. And, I'm just not going to try to compete with some of these guys. They have a great marketing team or whatever. So at the end of the 1 week mini course, I've added an updated weekly option strategy for SPX that you should be able to trade on your own after you're done watching the entire series. So that research video is not on YouTube. You can only get it if you take this course. So if you're interested in trading weekly options on SPX with updated research, go ahead and sign up for the course. And again, that's over at optionstrading.help/index options. And you can get started on that today. I'm going to put the link in the description too. All right, so let's go ahead and get into a couple of the main reasons why traders love trading index options. And the number one reason, this is for me, is that it's cash settled. And this is different from trading, and this is the difference between SPY and SPX, right? It's the difference between trading the index option versus an ETF option. It's cash settled. And what does this mean exactly? So the reason why indexes are cash settled is because you can't trade the index itself. For SPX, I'm going to name a couple: SPX, RUT, the VIX, NDX, DJX. These are all indexes for, the Russell 2000, the VIX index. You can't buy and sell the VIX itself. It's an index. It's just sort of an informational vehicle that's showing the average or whatever of all the stocks in that particular index, like the SPX, right? You can trade options on them directly though, which is what we're talking about today, trading index options, because you cannot buy or sell the index itself. So think about the term, the idea of assignment, right? Well, if you can't own SPX and you get assigned, well, what are they going to give you? And the answer is nothing. They can't give you. So what they do is they settle that difference in cash. So here's an example. So let's say you sold a call credit spread on SPX, for example, and you're kind of in the money and then everything expires. The short strike goes in the money and the long strike stays out of the money. It kind of expires between your strikes, if you will. Well, in that scenario with SPY, you would be assigned 100 shares of SPY. Not a big deal unless you have a small account, and that would probably hurt. But with index options, there is no assignment because it's cash settled, right? So that's sort of the second thing, right? There's no risk of assignment because it's cash settled, and there's no risk of early assignment because no one can choose to exercise their option early. So this is the idea of American style options, which is more like SPY, versus European style options, which are traded like the indexes. Indexes are European style options. So the way they do that is once it lets something expire in the money, they simply look at the trade and say, okay, well, did you make $100? Did you lose $100? Whatever. And the cash is settled, meaning they're going to put money into your account, or you're going to get to keep the money that's already there, or they're going to, you're going to lose money and that money's going to come out of your account. So it's pretty simple. They just calculate the profit or loss, and it is settled in cash, right? So a lot of people like this. They never want to have to deal with, getting assigned and all that stuff. The number two, which I kind of mentioned already, is the risk of early assignment. And here's where this matters to me. So I trade a lot of short-term options, usually, 7 days. I know we've talked about 0 DTE before, but with short-term options, that's the time that you're most at risk of early assignment. Let's say your options were in the money and you had a sold option in the money. So if you're trading short-term options that are near price, that's something that I do. I don't want to have to worry about a trade going in the money. Let's say I have a short call or whatever. I don't want to have to worry about my short call going in the money and me getting assigned and sort of knocking me out of the trade. And what that does from a mentality sort of standpoint is if you enter a credit spread or whatever kind of probability style trade, and you're unable to stay in the trade because you're worried about being assigned early, what you're doing is you're cutting yourself off of letting the trade play out. So if you have a mathematical trading strategy, which is what I do a lot, and there's let's say there's a 60% chance this thing expires out of the money. Well, if it goes in the money, and we'll talk about this maybe in another episode, there's a whole thing on probability of touch. Well, if you're trading something, there's a huge probability that the price is going to touch that short strike. And then the answer is, what are you going to do about it? Right? So if you don't have to worry about early assignment, then you don't have to do anything. You just let the math play out, or at least allows you to let the math play out a little bit more than if you were holding SPY and you're like, oh man, it's really deep in the money, and you just, you don't want to get assigned early. So the idea that you can trade those shorter term options without that risk of early assignment, I think is a huge bonus, and this is why it allows me to trade those shorter term options. Now, if you're trading 30, 45-day credit spreads on SPY, it really doesn't matter, because if you're trading out of the money or even in the money or right at the money, the risk of early assignment really is closer to expiration. I know it's very rare. I've actually never had that happen to me. So it's, I don't have a lot of experience with that because I try to avoid it. But basically, the risk is mainly towards that last week or so of assignment. So that's another reason why, I like to trade short-term options on indexes, because I don't have to worry about getting assigned. The last thing I'll mention about index options is a sort of preferential tax treatment of your profit and losses. I'm not going to go in detail here because I'm not an accountant and I'll probably screw it up. Just Google index options tax treatment and you can find some information on the CBOE website. But basically, there's a mix of 60-40 where you're not going to be taxed on all short-term gains. You can get some long-term tax credit. So it basically reduces your taxes on your profit a little bit. So that's sort of an additional bonus, which is another reason why I trade a lot of those. So that's all I want to cover in the podcast. If you want to take the mini course, as I mentioned, head on over to optionstrading.help/index options and get started, and I'll start sending you those emails. And then obviously, if you have questions after you get the email, you can reply and I'll try to answer those questions for you. So thanks for listening. I hope you subscribe and share this episode, and we'll see you next time.
Thanks for listening to the Stock Market Options Trading Podcast. To join our community of options traders, head on over to patreon.com/vertical spread options trading for details. But before you go, you should know that everything discussed on this podcast and in this episode is for informational purposes only and should not be considered financial advice of any kind.